the establishment to maintain a lid on gold and silver prices because of its accuracy in forecasting inflation and in forecasting the amount of stimulus that's being introduced into the economy in the form of paper currency. And that's been blown off recently.
Hey friends, thank you so much for tuning in. This is Sean from SGT Report. We appreciate it very much. Hey, what a timely day for this conversation. Honestly, so serendipitous. Silver absolutely monkey hammered today, down about 10%. It was down 266 at one point today, friends. Gold down 52 at one point. The day finished out with silver down $2.33 and gold down $44. But honestly, guys, have you ever seen anything like this? It really should be going up the other way. On the line right now, we have David Garofalo. He has an illustrious 30-year career in mining. He's been at the helm of a number of the largest gold and copper producers in the world, including Agnico, Eagle Mines, Hudbay Minerals, and most recently, he was the CEO of Goldcorp, which was a top 3 global gold producer. Guys, this is a sponsored post from our friends over at Gold Mining Inc. and Gold Royalty. And as I said, it couldn't be more timely. David joins us now. How are you, David?
I'm great. Thanks for having me on.
Well, thanks for coming on. Honest to God, I bought some silver over the weekend. I guess I should have waited till today, David. It's just the way this story goes. It was pretty crazy to wake up and see silver down $2 an ounce, when honestly I really think it should be going the other way. And gold too. What do you make of today's price action?
Nothing goes up in a straight line. Don't lose faith. The underlying fundamentals are still profoundly strong for gold and silver in particular. On the gold side, the Federal Reserve and central banks globally are going to maintain the stance of quantitative easing for the foreseeable future. The amount of debt that's been layered on both at the government and corporate level is unsustainable. They'll have to print their way out of debt. And you heard Jerome Powell say a few weeks ago, we're not even thinking about raising interest rates. There's just no conceivable scenario where interest rates are going to go up given the amount of spending that has to occur by government just to sustain some economic activity. And if you're looking for outsized leverage to what the gold price is going to do, I'd say buy silver because historically in a bull market, silver trades at a 40-to-1 ratio to gold. Today it's like 70-to-1. And so silver really hasn't participated, notwithstanding, the rally we've seen this year, it hasn't really participated to the degree it has in previous bull cycles. So if you believe gold's going to 3,000, as Merrill Lynch has been out there saying, silver is going to be $100 an ounce if gold hits $3,000 an ounce. And so there's outsized performance in silver. People have called silver poor man's gold, but I'd say that provides you outside leverage to participation in the gold price rally.
Well, I'm really glad that you are mentioning silver because our audience is filled with silver bulls. Me in particular, being a common man, I'm not a deep-pocketed millionaire. I prefer physical silver to gold because I can buy so much more of it. And historically speaking, I should be doing that because historically speaking, we're no longer seeing the 15-to-1 silver to gold ratio that we once saw. Let me ask you this. Speaking about silver specifically, when we see corporations like Amazon, just one company valued at $1.48 trillion. Can you just convey to the audience how tiny the total physical silver market is?
Oh, it's a fraction. In fact, if you took all of the gold and silver companies collectively in their market caps, they're smaller than Apple. If they're probably less than half of what the size of Apple's market capitalization is. So it's tiny and obviously a fraction of Amazon. So it's like, when you see capital start to come in a large way into the precious metal space, it's like trying to put a herd of elephants through a keyhole. The door is going to come off its hinges. We haven't seen generalists participate meaningfully in the precious metal space, but inevitably they'll have to hedge the correction that's inevitably going to happen in the general equity markets, and the reckoning that's going to come on the debt side and the credit side. Gold will be seen as a safe haven again, increasingly from generalist investors, retail investors. They haven't really participated meaningfully yet.
So when we think about how infinitesimally small the silver market is compared to just the market cap of some of these companies, in your view, is it because silver has been just ignored? Or have the prices been massaged and managed and manipulated that what we're seeing right now is potentially the biggest bargain in human history in a commodity, a tangible store of wealth? How is it that the silver market is so infinitesimally small when we see such out of control stock prices?
Well, I think the answer to your question is both of those factors. It's been seen as kind of a niche market, both silver and gold for that matter, kind of a barbarous relic, a quaint investment vehicle. And you can understand why we've been achieving new highs in the equity markets virtually every day for the last 4 or 5 years. You watch Bloomberg and MSNBC and CNBC, I should say, and it's just a cheering section for the general equity market. So when you're achieving highs in general equities, then why buy a hedge against volatility in the general equity markets? But that's going to change. I mean, given what's happening in the general economy, the valuations in the general equity markets are stretched beyond imagination, certainly beyond any rational or reasonable precedent. And so these are not sustainable. Given economic activity has been disrupted by COVID, we were facing lackluster economic growth even pre-COVID that just didn't justify the kind of valuations we're seeing in the general equity markets. And gold and silver is a barometer of negative activity in the general equity markets. And it's also a barometer of impending inflation. And given the amount of currency that's been printed, fiat currency that's been printed over the last decade, really since the credit crisis and even before that, but on a coordinated basis across all the central banks globally since the credit crisis, gold is a accurate barometer of what's coming on the inflation side. And you're right, it was manipulated for a long time. The gold and silver prices had virtually no volatility, and it was in the interest of the establishment to maintain a lid on gold and silver prices because of its accuracy in forecasting inflation and in forecasting the amount of stimulus that's being introduced into the economy in the form of paper currency. And that's been blown off recently. We've seen fines and sanctions against financial institutions that have manipulated the precious metal market. And now we're seeing a much more accurate view of what the precious metals is really forecasting, which is inflation. And that's going to happen in a very significant way, given the vast amounts of paper currency that's been introduced in the system globally, not just in the US, but across the world on a coordinated basis.
Right. And that's the part that's so stunning. I mean, we can look at the U.S. debt clock and see the thing ticking away at $26, $27 trillion, but that's just dollars. That doesn't include all the unfunded liabilities, Social Security, Medicare, and it doesn't account for all of the money printing in China and Japan and in the Eurozone. It's just stunning. You used the word barometer. What a great word. I just think that as it relates to gold and silver, that barometer is broken, or it's been managed so that it doesn't signal that there's smoke and potentially a fire brewing, so that way people don't run into the precious metals. I think the establishment, the powers that be, want to keep people away from the precious metals, so they control that barometer. And you mentioned some of these fines and indictments. Deutsche Bank gold manipulator, quote, spoofing was so commonplace, I figured it was okay. So now we see this stuff coming into the wide open. I guess I should say this in interest of your background for those that don't know. As the CEO of Goldcorp, David made history last year when he spearheaded the $32 billion merger of Goldcorp with Newmont to create the world's largest gold production company. So in a minute, we're going to talk about your new venture, Gold Royalty Corp. But let's talk about the tide turning. We've recently seen even Warren Buffett diving into this space by acquiring a stake in Barrick Gold. What do you think drove that investment decision, and do you think it's going to drive others in the space to do what Buffett is doing?
Yeah, look, Warren Buffett is a value investor. He's certainly not seeing value in the general equity markets. I pointed to that fact earlier on. The valuation's been stretched beyond recognition in the general equity markets. That's certainly not true for gold equities. Gold equities are still discounting probably $1,400, $1,500 an ounce among the producers. In the juniors, the development stage companies like gold mining that I sit on the advisory board of and the Spawn Gold Royalty, which I'm running, these companies are still trading at significant discounts to their previous bull market valuations a decade ago. And the producers, as I said, are discounting about $1,500 an ounce gold, but we know gold is going to go far beyond that. It currently is. I mean, we're approaching $2,000 an ounce. We've achieved that recently and come off a little bit from that. But as I said, nothing goes up in a straight line. If you believe gold's going to 3,000, the leverage that these producers can provide is immense. But if you go down a tier into the producers, or the development stage companies like gold mining, that's really where the leverage proposition is to the gold price, because the producers have done a great job of becoming profitable and deleveraging and generating free cash flow and paying dividends. What they haven't done a very good job of is replace what they're depleting in the ground. The reserves in the sector are down 50%. Gold reserves are down 50% over the last 7 years. In fact, the gold producers are depleting themselves out of existence. And so they're going to have to turn their sights onto the developers like gold mining, and they're going to have to start buying the assets that gold mining has been inventorying for the last 10 years to replace what they're depleting. They're going to have to put capital in the ground to replace their depleting asset base. And that's where you're going to get outsized leverage to the gold price, is in those development stage companies that have been largely ignored over the last 10 years.
Well, just so people know a little bit more background about you, when you joined Agnico Eagle, the market cap was $100 million. When you left the company and became CEO of Hudbay, Agnico was valued at $10 billion, a 100-fold increase. Honestly, what's the secret to your success, and do you see yourself doing more of that in the future for investors like us?
Well, some of it was the gold price rally for sure. I mean, in the 12 years I was at Agnico as CFO, gold price had gone from $250 an ounce to almost $1,000 an ounce at the time, which seemed crazy. Obviously, we've gone well beyond that. But the other thing that we did very well at Agnico, and we're looking to do the same thing with gold mining, and that'll support the gold royalty story as well, is we put money into the ground. That's where all the value is created in the mining business, is finding something and drilling it out that people didn't know existed before, and creating vast amounts of wealth for your shareholders by developing those assets into productive mines. And that's effectively what we're trying to do with gold mining. We have a collection of 14 development stage assets across the Americas in low political risk jurisdictions that collectively have over 25 million ounces of gold reserves and resources in the ground. There are established senior producers that have less than that, and we have it across 14 assets within our portfolio. And what we're endeavoring to do is put money into the ground to de-risk these assets, bring them into development stage, and start to joint venture them with some of the established producers in the space that are struggling to replace what they're depleting with their own production base. And so that's where we're going to create a lot of value. In the short term, while we're doing that, we're daylighting value by creating this royalty vehicle, Gold Royalty Corporation, which is currently 100% owned by gold mining. Gold Royalty Corp owns royalties in all 14 of those gold mining assets, of anywhere from 1% to 2% of the revenue that would accrue to the shareholders of Gold Royalty Corp. Our intention is to spin this out into a separate vehicle and start to attract capital into this vehicle separately, create a currency, and start to consolidate this large proliferation of gold royalty companies that we've seen in the space over the last couple of years, and put money to work in the ground and helping to develop new mines in the space and creating significant value for our royalty shareholders.
All right, well, let me ask you about Peak Gold. You've probably seen what I'm about to mention yourself, and I would have to believe that your view is the same as mine. So here's what I think is happening as it pertains to Peak Gold. You already mentioned that the majors have underinvested in their operations, and we've seen a decline in the stuff being mined out of the ground in the last 7 years. So now what I'm seeing floated about in the mainstream Mockingbird media are stories about mining asteroids. Right? There's so much gold and silver and precious metals out there that it'll be a no-brainer to mine asteroids. I think that's the most preposterous thing I've ever heard, but I had a debate with a friend who believes it wholeheartedly. He thinks it'll be simple. And I thought, well, you must never have held a 100-gram gold bar in your hand, because this stuff is awfully darn heavy. And the process of mining, it's hard enough on this planet. David, let's talk about Peak Gold. And what do you make about that, what I'm calling nonsense, mining asteroids?
You're right on the peak gold side, and I referenced this a little earlier on. Reserves have declined. We saw peak gold reserves 7 years ago, and we've been on a steady decline to the point we've lost about 50% of our global gold reserves across the existing gold sector, and that's just been simply through depletion and the underinvestment in exploration. But there are still discoveries to be made within this current terrestrial world. We don't need to go to Mars or to the moon to mine gold. There's lots to be found, but we need to spend money on exploration. We need to explore. And there's been a significant underinvestment on exploration over the last 10 years. In fact, juniors in the sector have, until recently, been unable to raise any equity in the markets. That's only been a recent phenomenon where they've been able to actually get some capital to put back into the ground. But typically, from discovery to first production is 15 to 20 years. So even if a significant discovery were made tomorrow, we wouldn't see the impact of that on production for a very, very long time, for a couple of decades. And clearly, reserves are a leading indicator of where production's going. Reserves have been declining. Production's been flatlining over the last couple of years, but we're going to start to see an appreciable decline in production. And that'll only enhance the fundamentals of gold.
So being one of the bigger names in the gold mining space, you decided after leaving Gold Corp to join forces with Amir Adnani over at Gold Mining Inc. And I've interviewed Amir. What made you choose going that route? And I guess tell us about the portfolio. I know there's 25 million ounces of gold resources, all of which were acquired at discounts to the market over the past decade. Why Gold Mining Inc.?
Well, a couple of reasons, and I alluded to this a little earlier on. I think the gold production part of the sector, the producers, the established producers, are going to have to turn their sights into mine building, and that's been a lost art. They came out of the last credit crisis quite burned, and their shareholders rightfully demanded they focus on returning capital to them. In other words, making their businesses more profitable and paying them back dividends, buying back shares. And in other words, sacrificing exploration in the ground. But given where reserves have gone, given where production is likely to go, it's become an existential imperative for these producers to actually focus on building mines again. And so I wanted to focus on that end of the sector. And so what I liked about Amir's model is he was buying at the bottom of the market. He spent $2 to $3 an ounce buying those 25 million ounces of reserves and resources in the ground. And he bought them, when gold was $1,200, $1,100 an ounce, when these deposits seemed sub-economic. But at $2,000 gold, these have very, very attractive economics. And as I said, the producers are going to have to turn their sights back into mine building to replace what they're depleting. And if they're doing that, you're going to see stocks like gold mining's take off. And in the meantime, while we're trying to de-risk these projects and prove out their economics to the producers and start to track capital into them. And, Amir and I came up with the idea of daylighting value in the short term by writing royalties on each of these development stage assets and putting them into a separate vehicle. Because gold royalty companies typically attract multiples 2 to 3 times what producers do, because they're just taking top line exposure. They're taking a percentage of the revenue. They don't take any of the underlying construction risk, operating cost risk, political risk that's associated with these assets. And so we can create value in the sector right now for gold mining shareholders by either spinning out or IPOing this gold royalty vehicle in the short term. And that's why we've seen a bit of an appreciation in gold mining stock, nearly a doubling over the last year, because we've laid out our intentions to the market that we do intend to create this gold royalty vehicle and start to unlock value for gold mining shareholders, while we're trying to attract capital into these development stage assets from the established producers.
Well, let's talk about gold royalty right now being a part of Gold Mining Inc. Can you help me understand how that's going to work and how the spin-out will work? Because I want to just share with you one of my biggest investment blunders of all time. The stuff I've missed out on could keep me up at night, and this is an honest-to-God true story. I had heard, and this was back when McDonald's was trading at like $14 a share, $15 a share after correcting from like 21. I had heard that they had a little thing in their portfolio called Chipotle that they were going to spin out, and for every share of McDonald's you owned, you'd get one free Chipotle share. Now, do you think I was smart enough to buy McDonald's? When I was smart enough to think that through and smart enough to know it and research it and find it out, but I didn't really research Chipotle. I had no idea how big it was going to be. So how does this work with Gold Mining Inc. and the spin out of Gold Royalty?
Well, Sean, that's a really good analogy, actually, because if you're buying a gold mining stock today, you're getting the gold royalty opportunity for free. And so how we spin that out ultimately, we're still trying to figure out whether we do it as an IPO and unlock value that way for gold mining shareholders, or whether we do a spin out or a merger. That will be determined over the coming months. But it will deliver significant value for gold mining shareholders, and you don't have to pay any incremental value to get that. You can just buy gold mining stock, today and realize that value in time as we unlock the potential of the gold royalty vehicle. So it'll ultimately be an independent company, but it'll provide gold mining with a publicly traded investment in gold royalty that it can trade, it can sell, it can do a number of things, it can dividend it out to its existing shareholders. There's a whole host of things we can do to unlock value, trap value right now, and deliver that to gold mining shareholders.
Alrighty. And guys, just so you know, full disclosure, I don't currently have a position in Gold Mining Inc., and this is not a solicitation to buy or sell any securities. Do your own due diligence. As always, when I have these interviews with gold company CEOs and silver company CEOs, as you know that I do over the years, do your own due diligence. But for those who are still with us, explain to me what a gold royalty company is, because I'm still a little unclear about that. You mentioned that they trade sometimes at premiums to the gold mining companies themselves because they don't have that risk. Just help us break that down. What is a gold royalty company and how will yours function?
So what we do is we take a small percentage of the revenue, the top line, from gold mining companies. So in the case of the 14 development stage assets within gold mining, we own a royalty equal to 1% to 2% of the revenue that eventually will be realized from those projects once they're operating mines down the road. So once they're developed and up and running, we just collect a royalty check every month of 1% to 2% of the revenue. So we're not taking the operating cost risks. So if there's operating cost inflation, there's capital cost inflation, we're not taking that risk. We're just taking a fixed percentage of the top line of the revenue. And that provides us full leverage to the gold price. So gold price goes up, we participate in that obviously because the royalty goes up. If the underlying asset grows geologically, say they find another deposit right next door to the one that we have a royalty on, we get to maintain a royalty on that new deposit because it's within the area of influence around the one we have the royalty on. So we have leverage to exploration success. We have leverage to a higher gold price. And the way we're structuring this is by spinning it out from an existing development stage company, an existing mining company, gold mining. It does have significant precedent. For example, Franco-Nevada, which is the biggest gold royalty company in the world, was spun out by Newmont, which is the biggest gold mining company in the world. Wheaton Precious Metals, right here in Vancouver where I live, was spun out by Goldcorp, a company I used to run. So it's quite common for these royalty vehicles to be spawned from existing mining companies like gold mining with that kind of sponsorship. Because what you have then is an underlying asset base that you can underwrite royalties from and then separate it into a separate royalty vehicle that provides full leverage to the gold price and full leverage to the exploration success of the underlying assets the gold mining companies are running.
Well, that's so interesting. You want to hear another funny story? I think you'll be amused
Sure.
by this. And I think, honestly, as I replay my history, which I do far too frequently, this goes back to about 2001, 2002. You guys can look this up, 100% true, going from memory here. There was an oil royalty company by the name of Prudhoe Bay. And I think the ticker, if I'm recalling correctly, was BPT. And my friend told me they are doing a 100% dividend. The stock at the time was $14 a share. So a 100% dividend, meaning when you held the shares on X date, you're going to get paid out $14 a share. And I thought, well, that's too good to be true. That couldn't possibly be a wise investment. That's way too good to be true. So I didn't buy it. It happened. The shareholders got their $14 a share. And over the next couple of years, that stock went to $100, north of $100 a share, as it kept paying out huge dividends. So, friends, I'm not telling you that's what's going to happen here, but do your own research on this stuff. Dig in, because sometimes all that glitters is gold. And again, I'm not saying that's the case here, but isn't that a funny story, man? I've got more woulda, coulda, shouldas. Don't even get me started about Apple.
Yeah, we've all had some that we've missed along the way. But that's why I'm here today. Is I do see this as a tremendous opportunity, very analogous to the examples you're giving, and we're at the very genesis of what we're trying to do and unlock value in gold royalty. We've only just underwritten these royalties. We've only just put them into a separate standalone vehicle, and we're only just starting the process of bringing this to the public.
Yeah, well, in my case, and I hate to keep bringing it back to me, I think that the powers that be, the universal powers that be, had me not make those decisions because had I made them, I'd have become a multimillionaire, and then I wouldn't be doing this, right? So other great things have come as a result of me not making those prudent investment choices when I had the chance. All right, final question for you, my friend. Silver at $27 in a world drowning in fiat, gold at around $2,000 in a world absolutely drowning in fiat and debt, your prognostications on where the price could be in the next 10 years?
Well, 10 years is a hard horizon to look over, but I would say it's no coincidence that Merrill Lynch came out with a $3,000 gold target in the next couple of years. And where that came from, really, I think, and this is my thesis, is gold back in 1981 peaked out at $850 an ounce. That doesn't seem like a lot relative to where we are today at 2000, just under $2,000 an ounce. But that's 1981 dollars. If you apply an inflation factor to that, in today's dollars, that's close to $3,000 an ounce. So I really think that's where Merrill Lynch pulled that number out at the end of the day. So we're a long way from achieving that peak. That's another 50%. Well, if gold's going up by 50% over the next year or two, as Merrill Lynch is predicting, then silver is going to go up 3 to 4 times that in percentage terms. And so it's not inconceivable to me that we're going to see a floor price for silver at $100 an ounce.
Yeah, I don't think that's anywhere near inconceivable. And, I talked to others in the space like Mike Maloney and Bix Weir and other friends of mine that have been at this for a long time, people over at GATA. They think it could easily go to 500, but we'll see. I just think that it is one of the most undervalued tangible financial assets, stores of wealth on planet Earth, silver, and then, of course, gold. All right, well, Gold Mining Inc., let's take a look here. The ticker on the TSX is gold, is that correct?
That's right.
GOLD.
Yeah.
Okay.
Hard to forget.
Yeah, that's a good one. And then on the
also over the counter, yeah.
Yeah, in the States it's GLDLF.
That's right.
All right. So in theory, if people took a position, and guys, you never want to throw all your money at any one stock, although I should have done that with Apple in 2002. If you took a position in this company, you're going to get some gold royalty shares or potentially at least some profit out of gold royalty in the future?
Yep, that's exactly right. Yeah. So again, to your analogy of McDonald's and Chipotle, you're buying gold mining, you're getting gold royalty for free.
Okay. All right. Very good. Well, it's always intimidating to have on a big-time CEO of a huge mining company, but I'm always surprised by how friendly you all are. So thank you so much, David. I really appreciate your time today.
All right. Thank you. You've been very friendly as well.
Thank you. And guys, thank you so much for tuning in. You know how much we appreciate it. A special shout out to our patrons who are keeping us in the fight. And guys, for real news, you can visit us directly at sgtreport.com 24/7. Thanks so much for tuning in. Bye-bye.
And this should come as no surprise. Marie Elizabeth make you want to barf harf. She is a clown through and through. And I mean that literally. She was an analyst for the CIA, the Directorate of Intelligence, focusing on Middle Eastern issues. And she also was a big part of Obama's security strategy, as well as John Kerry. And she seems to be the person that goes on Fox to fact check everybody and sit there with a little smug face on.